Yo, what's going on, everyone? Welcome back to another video. It's been a long time since I've posted. I've recently gotten busy with school, but that is kind of an excuse and it is a little bit of a lie because I'm just not interested in YouTube as much as I used to be. But I'm gathering the motivation and interest to start posting more oftenly now. And I started realizing that a lot of my videos were just repetitive, right? And I get bored really quickly, right? Same thing with Forex. I got extremely bored with Forex. I get bored of things really quickly, and I like to do multiple things, change things up. So I thought, you know what? Instead of just posting the same videos that are getting decent amount of views, why don't I post something which is more effective, more helpful, and overall more enjoyable for me and for the viewers? So this video is not going to be that type of video. This video is going to be another repetitive video. So if you do like this, then leave a like, sub. If not, I completely understand. But without further ado, let's get straight into this one. So in today's episode, clip, whatever you want to call it, we're going to go over how you can catch big moves on Forex. And I'm not just talking about high RRs, 5 to 1s, 10 to 1s. I'm literally talking about big moves that make big moves. So it's pretty self-explanatory. So without further ado, let's get straight into it. There's a couple things I want to talk about. So the first thing is the subjectivity in Forex pairs. So a couple of you might watch a video, an order block video, or a video referring to liquidity, or a video referring to market structure. And then right after you're finishing that video, you finish it up, you head over to the Forex charts, and you try to implement everything that you just learned. But some of you might find it easy, but majority of you are gonna find some trouble. It's gonna be a little bit tough. So the issue that you're facing has nothing to do with the concept. Rather, it's the issue with using different pairs. So I'll give you a perfect example, right? Not all men are the same as other men, and not all women are same as other women, right? Same thing goes with pairs. Not all pairs are the same as other pairs that you've traded. So a clean example that just came up in my mind was if I am trading Euro USD and I make a video about liquidity on Euro USD, that liquidity concept is extremely subjective to just Euro USD. Now that doesn't mean it's not going to work on other pairs. All that means is the way I teach liquidity, the way that I implement liquidity concept on Euro USD will differ compared to pairs such as we won't get into the depthness of which pair, but it's just going to differ from other pairs. Quick example, let's take a look at this. Euro USD in the last couple of months has just been following this static pattern. We take out a low. So price action takes out a low, and as soon as we finish taking out a low, the market finds itself retracing back to the original area or the most recent expansion, and then it mitigates the order block, which that supply zone fuels the new future move to the downside, right? If that didn't make sense, then I'll provide an example for that. So no worries, here we are. So we can see that this was a current low that was being maintained, as you can see, and then the market ends up breaking past that low with this very move right over here. Now what we're gonna do now is we're gonna refer back to the most recent expansion that caused that break of structure. In this case, the most recent expansion was right over here, and you could see that price uses this area as a level of supply, as a level to push away from, and then the market just goes and dumps all the way back down. Now this isn't just it, it's basically been continuing the same pattern over and over and over and over again. Right, we can see this one right here. Price action goes down once again. It takes out this low. Now here's something interesting. Here's a tip. So the expansion move down that broke the previous low. So in this case, this is the expansion move down, and this is the previous low. That wherever the expansion move finished will be the next future low. So in this case, this was where the expansion move finished. We created a low, and now this is the new low. So then price action is now going to use this as a level of you could say liquidity, because essentially what happens with liquidity is the market is constantly grabbing it and then moving away. And in this case, we're grabbing or we're breaking past a low and then we're moving away. So it's essentially just a low is created, it's broken, and then a new low is created and then it's broken. And then once again, a new pattern. There's another low right here. It's broken, and it just keeps continuing over and over and repeating itself until it reaches that point where price finally reverses. And then we can see that the same thing is happening over and over again. Here's another low, or here's another high that took out this low. So price action goes there, does a little bit of miscellaneous stuff that I'm a bit that would take too long to explain. but we can see that there's some type of distribution and liquidity being offered over here. And then after the distribution is offered, the market does the same thing. It goes down, takes out this low, and then what happens? You guessed it, price retraces back to the original area where the most recent expansion was and where there was an area of supply at the very high. And then as you can see, the market uses that level and repeats off of it, pushes away from it. So we understand this. Makes sense. We're all there. Boom. 1, 2, 3, 4, 5. So now the question comes, how does this connect to your original topic of the video? So as I was explaining right before I use this as an example, I was explaining that not all pairs are going to use the same, or not all pairs move the same way. And there's patterns for certain pairs. So as I explained, Euro USD has this pattern where it retraces or breaks a low, retraces back to the original area where you could find the supply zone, and then price uses that supply zone to push away from it. That's Euro USD. But if I go to a pair such as NZD CAD, completely, okay, that's a terrible example. Let's go to CAD CHF. Yeah, here's a good one, CAD CHF. You can see it's a completely different pattern. So if you're trying to implement the concept or the concept that I teach on Euro USD, but on a completely different pair such as CAD CHF, which moves in a different way as well, then you're not gonna find much success there. It's gonna come back to how does Traq trade Euro USD? Okay, he trades it this way, so that means I'm gonna use this concept on Euro USD, and therefore you're gonna be more effective with the implementation of that concept. But if you're using the concept that I teach on CAD CHF on something like what, USD MXN, you're not gonna find much effectiveness there. Although the concept is the same, you have to tweak it up. You have to add your little spices to it. You gotta season it up a little bit. So and then after you season it up, you tweak your concepts, and then you turn it into your own way with the understanding of how the market works on this pair. That's when you're gonna get the light bulb moment. So for example, the first thing, before you even find a strategy, the first thing you have to do is analyze the pair. Understand, and by analyze, I don't mean technical analysis. Analyze and understand the ins and out of the pairs. Now, when someone used to say this to me, I went straight to timing. I was checking the timings of when these big moves would happen and when this big move would happen. But it was just, there wasn't enough information. It didn't seem important to me, and I felt like I was just wasting my time. And essentially, I was. Not that timing isn't important. I just don't use it into my trading as someone else might. But yeah. So what did I do? So what you're supposed to do when someone says, or what I do now when someone asks me to analyze and critique a pair, what I do is I just check the pattern of how it's been moving in the last few months and days and weeks, or possibly even hours. So we can see that overall we are heading downwards on the daily time frame. If I zoom out, we're heading upwards. This is CAD CHF. What's the pattern that the market has been following? The pattern is the market goes down, breaks a low, and comes back, makes a deep retracement, and then goes back down. Now we created a new low. Here's another order block. Price is gonna go up, create a deep retracement into this zone, and potentially go back down. Now I'm not here to analyze the actual pair, so this is incorrect, by the way. If you really want my opinion, this is incorrect for several reasons, because I did not zoom out. I'm merely just analyzing the most recent daily price action. But so now you understand how CAD CHF moves. So for example, right, you might see an order block after you watch my order block video. You might see this, and then you might say, okay, Traq did say that there's an order block. If there is an order block on the daily time frame, I should look to sell there, right? And I probably may have even provided an example of that daily order block working out perfectly. So you go on to CAD CHF, you try to implement it. What happens? Margin call. And that's what you want to avoid. So moral of the story, make sure you understand how the pairs are moving. So now that I've gotten the main point out of the way, because remember, before I teach you a concept, I have to give you the ins and outs of how you want to implement it, right? And then the elements of implementing it too, because there's one, how you implement it, and then there's the elements of implementing it. And the first element is finding your pair. So now that we've gotten that out of the way, let's move on to Euro USD. Matter of fact, no. Let's move on to XAU USD, because I actually have a trade example that I wanna that I can provide for this pair. So we can see in the most recent weeks that overall we have been heading down, but we've reached like a plateau where sellers are no longer in control and buyers are somewhat taking control over the market. So, you know, how now you might be wondering, okay, Track, how do you catch the big moves? Now, here's where I'm going to get the secret sauce in. It's not really a secret sauce, but, you know, I want to add some hype to it. Anyway, so the first thing you want to do is figure out where your swing point lows and swing point highs are. I'll give a clean example of that. So we're going to start off from March, 2 years ago. So the first swing point high is right here, and then here's a swing point low. And then here's a swing point high, swing point low, swing point high, swing point low, swing point high, swing point low, and a potential swing point high. Now you might be wondering, why does this classify as a swing point? What is a swing point? I got you. A swing point is essentially any move in the market that created either a big impulsion to the upside or downside. So we can see that right here, this is a move in the market. It created a big impulsion to the downside, and then that move finished and it was followed up with a big move to the upside. So essentially it's higher highs, higher lows. But what I refer, and we also have a whole lesson on this inside of our course, the mentorship. It's called macro lows versus micro highs, right? So what are macros? Macros are like the most important moves that create big, that creates a big visual impact on the daily 4 hour, the bigger time frames. Whilst micro lows are the structure that's inside the macro move down. So for example, we have this macro high that created a macro low. Inside of this high to low, there's a bunch of lower time frame structure going down like this, and that's considered a micro. Right here we can see that this is all macro. So now that we got that out of the way, now I'm gonna go back to our first point, which was, what is the pattern that gold is following in the market at the moment? The pattern is, as soon as we take out a low, right, what does the market do? The market refers back to the original expansion and finds the supply zone at the very top to push away from it. That's what we have right here. So we could see that if you were a participant at this point in the market, right, you would have been expecting price to reach this area of interest, and then once the market would reach that area of interest, that is when you want to add your confirmations, add the finesse, you know, the confirmations, the Wyckoff, the liquidity grab, whatever you have. Some people use order flow. Be my guest, do whatever you want, but just make sure you're waiting for that confirmation. You get me? Now that we got that out of the way, someone might add a question. Okay, so price is at this point right now, but I want to be longing, I want to be shorting at this point. That is about, let's see how many days that took. 1, 2, 3, 4, 5, 6, 7, 8, 9. So that took 9 days, essentially 2 trading weeks. Yeah, 2 trading weeks. Technically, yeah, 2 trading weeks. So someone might say, okay, I don't want to be waiting that long. Well, here's the thing. There's a bittersweet thing about trading and finding a strategy. Once, like, I'll give the example of marriage. Once you marry a girl, it doesn't matter what happens, you're now committed to her and she's committed to you. You can't go back because you find another good looking woman, because you're not a man if you do that, right? So once you're committed, you're committed. In this case, if we have a strategy, we're committed to following those rules. Now what that also means is that if I do find a setup that looks beautiful but it doesn't match up with my rules or requirements, then I can't take that strategy. And what happens if you do? Well, the thing is, the second you take that trade and it goes against your rules, your strategy is no longer a strategy. It's more of a tragedy now, because essentially you have no book. You're not referring to anything, right? You don't refer back to any objective information to back up your reasonings for why you do things. So for example, right here, let's say clean entry, but doesn't match up my trade and I still take it. Right there and then, I've already psychologically and emotionally disregarded my strategy and my rules-based system, and that opens the door for me to now trade emotionally more into the future. That's how the psychology works. The second you make one mistake and you follow it up with another mistake, you've already opened the door to emotions and irrationality. Good. Let's move on. So now price action reaches a zone. So the answer to your question would have been either be patient or create another strategy that would allow you to be intraday trading, and stick to those strategies only when they're applicable. So then price action reaches a zone. I'm not going to talk too much in depth about the lower time frame confirmations. Rather, I want to talk about the volume. Now, we've all seen those times in the market, those examples where price action reaches your zone. You're waiting for that lower time frame break of structure. Price provides that break of structure, right? But the thing is, we don't actually get the biggest retracement back to, say, an order block that's over here, and the market just dumps all the way down. I've personally seen this happen on gold multiple times, and it's pretty annoying to say none the least. But this all has to do with volume and imbalance. So for example, let's go to the 1 hour time frame, and we could see that there's a clean break of structure at this point right here, a clean break of structure. Now, a lot of people, a lot of traders would be expecting a retracement back here, and that's 100% valid. But will we get that? Okay, so it looks like we did get this. This was simply just a bad trade. Let's see what else happens. Find that move of volume, and I think it was right over here. Yes, it was right over here. So you get this extreme push down that breaks structure over here, and it invalidates demand right over here. I'll zoom in to further explain on that. So what is our structure? Our structure, there's a low, there's a high, there's a higher low, there's a higher high. All right, done. Market breaks with this move, right? We end up breaking this micro higher low and this macro higher low as well. So that provides confirmation that, number one, this supply zone that I have on the higher time frame is valid. It's now valid, because before price action reaches the zone, when we were right over here, there's no confirmation that price is really going to use this zone, because for all I know and for all you know, the market can easily invalidate it. The only thing that actually gives us the confidence and confirmation that yes, the market will provide or will use the supply zone as a level to push away from is after the fact that we enter it. So it's basically a little bit of hindsight. Now remember, you're a lawyer, you're trading, you are a lawyer, and I'll tell you why. Because what is a lawyer's job? A lawyer's job is to break down the arguments of the opposition bit by bit in order to provide sufficient information and evidence that the opposing person's argument is invalid. You're doing the same thing, except you're not trying to invalidate it, you're trying to validate it. So step number one, price action enters my zone. I'm going to put this in my mind now. Price action has entered my zone. Now step number two, I have to enter the psychology that I am now waiting for something to prove that this zone is valid. Right? And in this case, the second we got that break of structure, step number two was accomplished. Step number three, find the order block. So that's your point. That's your cue to go to the higher time frames, look for the order block that was at the very high. So that may be right over here, or that may be right over here, so on and so forth. We're not getting too in depth about the confirmations behind it. We're just gonna talk about the why something like this happens. Because now look, one, price did move away off of your zone. So if you enter with a limit, that would have been a dub. But obviously we don't want to be entering with limits, because once again, what was my first argument? The argument was that there's no confirmation that this supply zone will hold. In fact, I can rather say that there's more certainty that this supply zone will not hold. Why? Because it's so much easier to go against something than to go with it. So how do you explain this? What do you do in a situation like this? Well, this goes back to lower time frame confirmation versus higher time frame confirmation. So let's take a big step back all the way over here. Do you see anything interesting? Before this move happened, before this big move, right? This big move with a bunch of volume happened. What happened? What was happening? Before the higher time frame structure was being invalidated, the lower time frame structure was being invalidated. So let's zoom in and take a deep look, and stay with me. This might be a little bit confusing, but stay with me. You have a low, you have a high. You have a higher low, you have a higher high. Price action breaks this higher low. Done. We're bearish, but we're only bearish on what? On the lower time frame, because the 4 hour still has this daily demand zone, or this 4 hour demand zone, which is maintaining and holding price back. Only after we broke past this demand zone, the market was then considered bearish on the said time frame, which is the 4 hour. But if I go to the 1 hour or the 45, I can see this and say, yep, 100% we're bearish, because the lower time frame has been lower time frame structure has been massacred. It's been broken multiple times. Perfect example: one here, one here, one here, and one over here. So we have multiple structure that's being broken on the lower time frame. So that explains the lower time frame. Now I'll explain the higher time frame. Now that the higher time frame was bearish, right? It's officially bearish now. The higher time frame has a bunch of power backing it, because structure is like a cycle. First thing is the 1 minute bearish. Okay, if the 1 minute bearish is bearish, then we have to move on to the 5 minute. is the 5-minute bearish. And then as soon as the 5-minute is bearish, we move on to the 15-minute. Once the 15-minute is bearish, we move on to the 45-minute. Once the 45-minute is bearish, you move on to the 1 hour. Once the 1 hour is bearish, you move on to the 4 hour. So basically, it's a cycle of going from bearish. Now this is bearish. Now 15-minute can be bearish. Now 15-minute is bearish. 45 can be bearish. Now 45 is bearish. The 1 hour can be bearish. And now 1 hour is bearish. 4 hours is bearish. But by the time that you reach the 4 hour time frame, there's already so many orders in volume that are over packeting the market in order to just go short that the market fully dumps at that point. So essentially, when every single time frame is bearish, all it's waiting for is the 4 hour time frame. And once the 4 hour time frame is bearish, you can already assume that the market is now just going to take off without you. So that means we have to dissect this. We have to dissect what's happening in the 1, 5, 15, 45, and 1 hour. So we're going to start off with the 1 minute. The 1 minute time frame. Although it's not the strongest, it's still effective if you know how to use it to your effectiveness. So how to use the 1 minute? The 1 minute. Look at the 1 minute structure and try to differentiate from bad volume and good volume. So you might see something like this. You might see something like this happens where price action. Oh, sorry, I just realized you guys might not be able to see that. I messed up my resolution a bit here. So let's say you're on the 1 minute time frame and you see a big move like this. Now on the 1 minute, this is going to seem like a lot of volume. But you later figure out that this was just a retracement and the market comes up impulses with something even stronger, with another move with more volume, and then you wait for the another move, another push down, and then this happens again. So essentially the 1 minute is extremely manipulative. So what you have to do is use supply and demand to your effectiveness. So for example, right, on the 1 minute time frame, there's multiple supply and demand zones, and if you go back to the left, there's a history of what was happening towards the left. There's a big history. So I could see something like this. There's a supply zone over here, but price action over here, where there was a breaker structure, wasn't actually in a supply zone. So rather, this was all manipulation. That's one potential possibility. Possibility number 2, price action enters the supply zone, and you wait. This is going to require a lot of patience. You have to wait for the most recent impulsive move, that impulse with a lot of volume, to break. So it's a game volume versus volume, demand versus supply. So this move up had a bunch of demand behind it. This move down had a lot of supply behind it. But now that this move down has invalidated and broken this move up, we can just make we can make a distinction between this move and this move. This move is stronger, it broke structure, it has more volume, it has more imbalance. This move is less stronger, it didn't break structure, and it's now invalidated. So at that point, you can look for shorts on the 1 minute time frame, find your entry, and then short. Now what you might realize is that the move that you catch on the 1 minute time frame is gonna on the 4 hour it's gonna be one huge candle going down, right? And I'll use the example of gold to prove that right now. So let's go back in time. Right here. So price action breaks structure. Let's go to the 30. Go to the 1 minute time frame. Okay. Seems like I can't go to the 1 minute. So just bear with me. Let's just assume that there's some type of order block over here. If I could go to the 1 minute, I would love to, but sadly I can't. But boom, right over here. So this move breaks structure on the 1 minute. Remember, we're not talking about the 1 hour, because the 1 hour is technically still bullish. We're talking about like the 20 minute, the 15 minute. On the 15 minute, let's go to the 5 minute, matter of fact. On the 5 minute, we can see that there's this big move up with a lot of volume, as I explained before. Now, this big move up was later invalidated with these two big moves down, because not only did we break past it, but there's also so much more volume in this move and this move and this move over here. So now you know that, okay, if it's a game of volume, the bears have already won. And if the bears have already won, then that's my cue to start looking for entries on the smaller time frame. This is where you could also use your other concepts, such as liquidity. We can see there's some inducement right over here, some double tops, and then price does its thing, enters the supply zone, distributes a little bit, and then takes off. Now, as soon as we distributed, right, as soon as price action distributed, you see there's a second entry possible right over here. The market is slowly taking off. Now remember, on the 5 minute time frame, right, zoomed out, we are bearish because we've broken structure here. But zoomed in, what am I? Before price action actually mitigated distributed, we were technically bearish on the micro 5-minute. If I'm zooming in now, right, I'm only using this price action. I'm not looking at the past. I'm using this. So we see we're bullish on the 5-minute. What I have to see now, what I'm waiting for, is the invalidation of this move and this move right here. Or if I even want to take it a step further, I could zoom in more and use the 1-minute, although it wouldn't be as strong. So price action does its thing. What happens? Right over here, we get that invalidation. Price action creates new structure. There's a new low right here, and then there's a new high right here. And then there's another new low right here, and then there's another new high right here. We've invalidated the previous higher low. That in itself, right? It provides you enough confirmation to confirm that the 5-minute is now bearish. Now the 5-minute bearish, that means the 1-minute is also bearish. Now it's job for the 15-minute to be bearish. So I go to the 15-minute. 15-minute time frame wise, here's my low, here's my high, here's my higher low, here's my higher high. I have to wait for the 15-minute last trading range to break, and in this case, it would be right over here. And now the market has broken that. So now you go to the 20-minute. Is the 20-minute bearish? Yes, it is. Is the 30-minute bearish? Yes, it is. Is the 45-minute bearish? No, because we can see that there's a low right here, there's a high right here, there's a higher low right here, there's a higher high right here. So we need to break past the trading range, this low and this high. This is the trading range that the market is currently gapped into. Now we've broken past the 45-minute time frame. We've broken past the 45-minute time frame structure low, so we're bearish now on the 45. Now we're bearish on the 1 hour. Now we're bearish on the 2 hour. Are we bearish on the 3 hour? Yes. Are we bearish on the 4 hour? Yes. But notice this. By the time you reach the 4 hour time frame, the market is already too strong and it's already provided its confirmation entry on the smaller time frame. So your best chance of actually catching an entry is to be patient and wait for the next higher time frame structure to be created. So in this case, we refer back to the 4 hour structure. We take a look at what our 4 hour structure is like. We see there's a low, there's a high, there's a higher low, there's a higher high, there's a higher low, there's a higher high, there's a higher low, and there's a higher high. Now, this higher low has been broken. This higher low has also been broken. So we're going to refer back to the most recent higher low that's been broken. And we need to check whether the most recent expansion move down that broke the most recent higher low has in fact created a strong order block or a strong move down with volume. So take a look at all this volume. In this case, we see that there's a supply zone right over here. And this is also the supply zone that's at the top of this move down. So essentially, you just want to be patient now. There's also a second supply zone right over here. And at these areas, this area and this area, these are the extreme crucial points of interest where you want to be monitoring that we don't monitor enough. The big mistake a lot of traders make is, okay, if price action isn't coming here or over here, then let me ignore all the order blocks over here and here. Rather, the markets are actually repricing. The banks are repricing their order blocks. So the order blocks that were created here, sure, they might be mitigated later on in life when the market does go up or whenever gold appreciates. But these order blocks are being created so that the market could mitigate them right away, so that there's more power in the move down. And let's take a look at what happens. Okay, the first area was not respected, yet the second area was. Now, once again, was there 1 minute time frame confirmation? Of course there was, because you can see on the smaller, not the small time, if I zoom into these wicks, we can see that price action has created multiple wicks, and these wicks represent confirmation and entries being provided on the smaller time frame. But did the market provide higher time frame confirmation? It did. There's a break of structure. But did the market reach back to these areas of interest? No, because by the time it got there, or by the time you understood and realized that there was an order block here, the market had already moved away from that point of interest. So what I've just done is I've broken down where are the most crucial and key components, or not components, where are the most key and crucial areas in Forex. It's the swing point highs and the swing point lows. And then number two, how you can take advantage of confirmation on the lower time frame and how to differentiate from bad volume and good volume. So if you're ever in a situation where the market has entered your point of interest and it's gone down on the higher time frame, you can already come to the conclusion, right? Talk to yourself, tell yourself that I've already missed the 1 minute confirmation, the lower time frame confirmation. It's time to move on. Now, once again, is this 100% true? No, this is subjective. This is fully subjective on gold, on XAU USD. That doesn't mean that if I go to Euro USD and US 30, it's not going to work, because it could clearly work fine for you. It just means that on gold, the market does not provide higher time. Basically, on the higher time frame, the market doesn't want to just roam around and give you entries and remain patient, right? Who wants to do that? Who wants to give entries to retail traders? no hatred against retailers, because I'm a retailer too, but that's just the psychology behind a bank and what they think. And that's exactly what I'm doing now at this point. We can see price action has entered my point of interest right here, the supply zone, at the very high, just as it did over here and over here. And now I'm monitoring this area for smaller time frame confirmation. That's it. I'm just monitoring for smaller time frame confirmation. I'm not going to be expecting a big break of structure like this, because by the time you get that big break of structure, price action has already moved away and you've missed out. So that FOMO that you're gonna get that by waiting for the higher time frame. So if you're trying to catch big moves on gold, number one, trade with the trend overall. Trade with the overall trend. And number two, understand the pattern. Once you crack down the pattern, right, it's very, very simple. Because for example, let's go to the 8-hour time frame. Right, there's a break of structure right here. Let's say price didn't enter this point of interest at first, but then there's this point of interest, right? At that point, there's another point of interest at the bottom right here. So once you understand that, understand the pattern behind gold, it's just money is just being printed left and right, left and right, left and right. Money is just being printed. So I appreciate all of you guys staying till the end. If you did, leave a like, comment, subscribe if you desire. If you didn't enjoy the video, dislike it. I don't care. Do whatever you want to do. But just if you personally did not like the video, right? Just do me one favor. Give me some criticism on how I can make it better. I won't take any offense whatsoever. I appreciate all constructive criticism. So I appreciate that. And once again, my next few videos are gonna be a little bit different from the iconic staring at a chart and talking for 30 minutes. I don't find it fun. I don't think you guys would find it fun either. So if you do have any tips or ideas of how I can make my videos more fun, more interesting, then once again, feel free to leave it in the comment section below. And if you're interested in joining the course, make sure you click the link in the description. And yeah, any questions, hit me up on Instagram. And besides that, thank you all so much for watching, and I'll see you all in the next one. Peace out.